Greetings everyone. Proceeding to our session, we come down to learn the calculation part, that is how to calculate the short-term and the long-term capital gain. So first we will move on to short-term capital gain. We go into detail about short-term or long-term. First we will understand some key terminologies which are available, which is a must to understand from the beginning. The Income Tax Act, there are four core components that are very essential to understand, which is before you. Full value of consideration, expenses on transfer, cost of acquisition, and cost of improvement. These elements together will determine the amount of taxable capital gain. So it is very important that first we understand this before we proceed further. The first term is full value of consideration. FVC, we use the short form or abbreviation as FVC. The full value of consideration, it refers to the total amount which is received or receivable by the transferor, that is the seller, as a result of a transfer of a capital asset. It is the starting point of computing the capital gain. It is important to note that FVC is not necessarily the actual amount received in cash. It might include monetary consideration, it might include fair market value of the asset which is received in case of exchange, and it also will include deemed consideration under a special provision. Example, stamp duty value in case of immovable property. So to make it more clear, let me go with an example. Suppose Mr. A sells a house for rupees 50 lakhs, but the stamp duty value is rupees 60 lakhs. In such a case, full value of consideration under the deeming provision. Okay, so this can be taken into inclusion, this can be included. Okay, so that means, because first the house is for 60 lakh, but including the stamp duty, now it is for 60 lakhs. First it was 50 lakhs, so this 10 lakhs of stamp duty will be included in this. Okay, similarly, next we have the terminology expenses on transfer. These expenses incur wholly or exclusively in connection with the transfer of the capital asset. Such expenses are deductible while computing the capital gains. Common examples will include maybe brokerage or commission paid to agent, legal fees, advertisement expenses for sale, or stamp duty in certain cases borne by the seller, etc. The key condition is that the expenses must be directly related to that transfer. It should not be that an expenditure of anything else can be included in. No, it cannot be done. For example, suppose if Mr. B sells a piece of land and he pays rupees 1 lakh as brokerage to the maybe broker, and 50,000 as legal fees for all the legal issues to be compiled, then the total of rupees 1,50,000 will be deducted from the expenses of transfer, because this is an additional expenditure that he bears. The third terminology is cost of acquisition. The cost of acquisition refers to the amount originally paid to acquire any capital asset, that is to buy any asset. For example, we can also call it purchase price, or here expenses incurred to acquire these assets are also included, for example registration fees, legal charges, etc. However, in certain situations the asset is not acquired by purchase, example inheritance, gift, succession, etc. In such cases, actually what happens in these situations, in such cases, the law provides that the cost of acquisition of the previous owner shall be deemed to be the cost of acquisition of the taxpayer. So this ensures the continuity and it prevents the avoidance of capital gain tax. So we consider it this way. Suppose Mr. X inherits a house from his father. The father had purchased it for rupees 10 lakh. Even though Mr. X has not paid anything because he has got it as a gift from his father, or he has inherited from his father, he has not paid anything, but his cost of acquisition will be rupees 10 lakh. That is, it's always the cost to the previous owner. I hope this is clear. Okay. Next, we move to cost of improvement. That is, cost of improvement is the capital expenditure that has incurred to enhance the value of the asset. It includes cost of additional or additions made to that asset or any alteration. It may include structural improvements, renovation that increases the asset value. However, an important rule applies here, that is, any improvement made before 1st April 2001 is ignored for tax purpose. Only improvement made on or after 1st April 2001 are considered. For example, if a house was renovated in 1998 and again in 2010, then the cost of 1998, that is improvement cost, will be ignored, whereas the improvement that was done in 2010 will be taken into consideration. There is a reason behind this, which you will understand it better when we discuss the long term, because here it is the base year that matters, which is 2001. We'll understand it in detail later on. Then there is something very important that you must always remember, that in cases where the assets become the property of a taxpayer, otherwise can be purchased, inheritance or gift or will or succession, then the cost of acquisition is equal to the cost of previous owner. As said, cost of improvement is equal to improvement made by both, maybe including the previous owner as well as the current owner, but remember, only improvement made after 2001 will be included, not before that. Okay. So put it here for it, and it applies to both, that is long term as well as short term. So capital gain is equal to full value of consideration minus expenses on transfer minus cost of acquisition, because here we use all these short forms: COA, COI and FVC. Okay. So we also deduct cost of acquisition from here and also COI, cost of improvement, and we get the capital gain. So each component ensures that only the real economic gain is taxed after deducting the genuine cost incurred in acquiring or improving the assets. Okay. So this is about the terminology and the basic formula for computing the capital gain. Now we come to the short term capital gain. We start with FVC, obviously, because the basic formula is same for both the cases, whether short or long. So how much money did the assessee receive from selling the asset, that is FVC? Maybe whatever amount, then you have to deduct all the expenses. We don't tax the entire amount. Why? Because the assessee has incurred the cost. So we deduct the three things, that is expenditure on transfer, cost of acquisition and cost of improvement. So after deducting these three, we get a provisional gain, not which is not final yet, because there is another item that is to be deducted, and that is your exemptions. That is your exemptions. So this is a relief which is provided by the law to all the taxpayers. Certain sections allow deductions. For example, section 54B for agricultural land, 54D, that is compulsory acquisition of land or buildings. So if the SSE qualifies these under these sections, then we reduce these exemptions only once if he qualifies. So this amount is taxable. So I can we can see here the formula before you is here, that is FVC minus EOT, that is EOT is your EOT expenditure on transfer, sorry, expenditure on transfer, cost of COA is cost of acquisition, then COI is cost of improvement, and finally the um, exemptions, and finally we result here with the short term capital gain. Let us go with a small illustration. By calculating this, we will understand the things better. So, Mr. Devesh purchased a plot on 17th August 2023 for rupees 20,000. On 1st May 2024, that means just within few months, he just sold it off. Sorry, not sold it off, he constructed a wall on it costing rupees 25,000. He sold the plot for rupees 80,000 and incurred brokerage for arranging the customers, that is rupees 5,000. You have to compute the capital gain. Okay, we have to compute the capital gain. So let us solve this for calculating the capital gain. Capital gain. The first thing that we are going to take into consideration is FVC, full value of consideration, which is rupees 80,000. Okay, rupees 80,000. After that, from this we will deduct all the expenses that are allowed. So less, the first thing that he was the cost of improvement, that is cost of improvement is rupees or maybe before that we will his expenses on transfer. Let us consider that first, expenses on transfer, because as he got the consideration, first he has to pay out the expenses on transfer, that is rupees 5,000. So the balancing is 75,000 rupees. After that, we will, this is your net sale consideration. Okay. After that, from this, we will again deduct all the allowable, less, maybe the cost of acquisition, COA, that is rupees 20,000. Then cost of improvement, that is rupees 25,000. Okay, so that makes it 45,000. So the short term capital gain is rupees 75 minus 45, that is 30,000. This is how we compute the short term capital gain. There is no indexation, there is no other calculation, it is simple. But you have to remember what expenses and what exemptions are to be treated and given the deducted from the full value of consideration. Next, we come to the long-term capital gain. Now, long-term capital gain, capital gain, we don't simply deduct the original cost. Why? Because we see what happens is price increases over time due to inflation, and taxing without adjusting for inflation would be unfair. That is, as I said, we have to take into consideration the indexation part, or maybe the time value of money, because the time value has changed, it changes over the time period. So here comes the use of indexation. What is indexation? Actually, indexation means adjusting the cost of acquisition and cost of improvement in order to take into consideration or reflect the inflation using the cost inflation index, CII. So instead of original cost, we used indexed cost. And the formulas which we use for indexation is before you. The first formula is the index cost of acquisition. Index cost of acquisition is equal to COA into CII of the year in which the asset is transferred, divided by CII of the year in which the asset was first held by the seller, or the financial year 2001-2002, whichever is later. Please, this part is very, very important. This formula, whichever is later. And why this? Because this is the base year. 2001-2002 has been taken as the base year. And similarly, as we index the cost of acquisition, we also index the cost of improvement. Cost of improvement goes with the formula, that is COT, that is cost of transfer, or improvement. It has to be COI, cost of improvement, into CII, year of transfer, divided by CII of the year of asset improvement. Whenever this improvement took place, we take the cost inflation index of that year. Okay, so maybe you can think of it like this, that is, suppose you have bought something. You bought something many years ago, and when the prices were very low, but today the prices are very high, so we increase the cost to match today's price level. So this reduces your taxable profit, which is very fair, because it reduces the taxable profit, and we bring the cost which was very low in maybe years back, but now we take it at par, we take that value at par. Suppose points to be taken into consideration. There is some important note as given below on your slide. That is, if the asset was purchased before 1st April 2001, then you can actually choose any one of them, that is actual cost or maybe FMV as on 1st April 2001. Whichever is beneficial, please remember that, okay? And base year, if the base year is 2000, because as I said, for indexation, one of the year is always considered as base year from which the inflation index is computed. So base year is which is taken for the present data at CII. It is the year of 2001-2002, and if there is an improvement before 2001, then in case of improvement we have to ignore, okay, and we do not take into consideration. Actually, see, what mistake we often make is that we forget whichever is later. Instead of that, we use the wrong CII. So include pre-2000. I want to say that in order to take the advantage of this indexation. But always remember, we don't have to go prior to base year 2001-2002. That has to be kept in mind. So formula is the same as we discussed previously. basic formula, that is we start with the full value of consideration, that is how much you have received by selling your product. After that, we deduct the expenditure on transfer, cost of acquisition, cost of improvement, etc., etc. But we also have to consider the this exemption if it is there. So the exemptions that are available are section 54, which is on the sales of residential house, 54B agricultural land, 54D compulsory acquisition, then 54EC is investment in specified bonds, 54F is sales of any asset and investment in house. So this has to be taken into consideration, that these things have to be. So we come down to the formula where it says here that LTCG is when we deduct from FVC, EOT, IC, OA. What is ICOA? It is all indexed. It includes the word index, and then all the exemptions are also to be taken into consideration. Okay, so we have to follow this sequence, and we will be uh, following this. Now this is the table which gives you the CII, cost inflation index, from the year 2001 to till 2024-25 onwards. That is 2001, since it is a base year, its value is taken as 100, and with the passage of time, taken into consideration the inflation or maybe the time value of money because of inflation, we have computed the CII. It is a standard table that is provided after obviously calculations, and where we provide it as a for the calculation of cost inflation index. Okay. So this is the formula, maybe any capital gain, long or short term. Sales consideration, FVC, minus expenses on transfer. We get the net sale. Always remember, we have this first, the sequence goes with expenses on transfer. Then we have the net sales. After, from this net sales, we go for COA and COI. We get the long term or short term because it is indexed. So this is the long term, obviously. Finally, in the end, we will deduct all the exemptions that are there, and we get the taxable long term capital gain. Okay. Now to understand it better, we will, the indexation part is specifically, otherwise transfer and gain you have understood in short term capital gain. We will, to understand it better, we will follow this illustration in order to calculate it. So let me read it first. Mr. Anand purchased a house property as on 17th August 2002 for rupees 5 lakh. On 1st May 2004, he constructed a new floor in the same house for rupees 2,50,000. Then on 1st October 2019, he sold such house for rupees 1,80,000 and incurred a brokerage of 2% for arranging customer. Compute the capital gain. So I think obviously it is your long-term capital gain, because it is the number of years are from 2022 to 2019. The transaction means almost 17 years are being involved here. So obviously, if it is piece of land beyond 12 months, 24 months, sorry, 2 years, it goes for this. And this question includes both the expenditures, that is improvement, as well as exemption, sorry, brokerage, that is there. Two expenditures are there, expenses on transferred and expenses of improvement. Okay. So let us calculate it. So the capital gain FVC is rupees how much? 18 lakh. Okay. After that, the first that is we are going to deduct from this is the transfer money. Less expenses on transfer, that is rupees how much? It is 2%. Now 2% of 18 lakh will be 36,000. So the balance is 17 lakh 64,000. Okay, 17 lakh 64,000 will be called net sales consideration. Okay. After this, we will deduct other allowable deductions from this net sale, that is COA obviously and COI. But COA, both the things will have to be indexed because it is beyond 24 months. So less ICOA. Now, how do we compute that? It is the cost of acquisition was rupees 5 lakh in the year 2002. So, 5 lakh, and as per the formula, the CII, okay, the CII for the year 2002 and 2019, we need to know that. So let us move back to this 2002. It is 105 and 19 is 280. Okay. Into 289 divided by 105. So this calculation comes down to 13 lakh 76,190. Okay. Then we have index cost of improvement. Again, the same formula goes. The improvement cost is rupees 2,50,000. Not improvement, maybe, yes, we call it improvement, but it is the construction of a new floor to that. So 2,50,000. And the cost of improvement first and divided by 113, which is equal to 6 lakh 39,381. Now these two amounts will be added together and deducted from 17 lakh 64,000. So this comes to 20 lakh 13 plus 6 20 lakhs 15,000 571. Okay, when we deduct this from here, that is your full value of consideration from this cost of acquisition and improvement. The amount, that is the long term capital gain, is equal to the difference between this amount and this amount is 2,51,571. I hope this is clear, that how we compute it. So, in fact, there has been a loss here instead of gain. because the cost of acquisition and cost of improvement is higher than what he received after selling the house. So there was a loss. There was a loss on this. So instead of writing the capital gain, we write loss, long-term capital loss. So this is all about your long-term, the calculation of the long-term capital gain and long-term capital loss that we understood with the help of this example. Okay, so that is all for today. Thank you.